Well, welcome everyone to another exciting educational class. Today we're excited to present to you how to buy a 2 to 4 unit building for only 3.5% down. It's not commonly known on how to buy a 2 to 4 unit building for 3.5% down. And more importantly, the reason that we thought we'd bring this topic to you is because with high interest rates, as high as in the mid sevens now, many of the realtors' clients are saying, well, the payment is too high for me. I'm uncomfortable making that type of a housing payment, or they just don't qualify. The payment is too big for their income. Their debt to income ratio is too high. It's out of whack. And so they say, well, then I'm just going to have to go into the rental market. And what we're here to present today is you need to then take them to the next step and look at how a 2 to 4 unit building will be able to bring that mortgage payment down, make it more affordable, get that client into the real estate market, get them into the real estate game. So we're excited to bring this to you for only 3.5% down. And without further ado, we wanted to let you know that this is being brought to you by Tony Marino. He's the branch manager at First Centennial in Naperville. He's a loan originator licensed in Illinois, Colorado, and Florida. So any of you Illinois realtors, if you're having clients that are moving to Colorado or Florida, please contact Tony. Tony will specialize in getting people into home ownership using down payment assistance where they might qualify. And lastly, he uses education to help people understand how they can become homeowners and own a part of the American dream. Again, this class today is how we can use 2 to 4 unit properties to help people become homeowners and own a part of the American dream. Some key facts. Homeownership is still the American dream. However, buying a home has been the hardest hit with the recent rise in interest rates. And we've seen them go from 2 to 3%. They're up to mid sevens now. That has caused a huge challenge in the real estate market because those that do have 2 to 3% mortgages, and that's nearly 50% of the people out there have mortgages in those rates, and they're not willing to put their properties on the market. They're not willing to sell, get rid of the 2 to 3% and jump into 7.5%. So the higher interest rates have led to higher mortgage payments. The changing interest rate environment has seen a dampening in affordability and in demand. They just, people are going like, I'm uncomfortable with that payment. I don't feel, like making that housing payment, or they just don't qualify to buy that single family home. So some questions before we get into today's presentation. How many of you have had clients that want to purchase a home, but that monthly home mortgage payment is much bigger than they expected? I'm sure some of you have had clients where they've gone to get pre-approved by Tony or someone else, and they come back and they say the payment is not what we expected. We're not willing to move forward. Or they just say we didn't qualify, we didn't get pre-approved. How many have had clients that did not qualify for a home mortgage because of rising interest rates? This is a big question. How many of you then showed your clients that a 2 to 4 unit building might have a lower monthly mortgage payment than a single family home? It's something that if I was a realtor, I'd be looking in my neighborhood, surrounding neighborhoods, looking for any 2 to 4 unit buildings. And as we see in the numbers that we'll go through later on in the future slides here, run the numbers and start presenting these numbers to your clients, saying that, if you're thinking of going into the rental market, maybe we should look at that 2 to 4 unit market, because you might just find that your net mortgage payment is less than that monthly rent. I've recommended this strategy to my daughter and to many of her friends, especially when they're coming out of college with these wonderful degrees. They got their jobs, they're getting paid good income. But when they go to buy that single family, they just can't afford the monthly mortgage payment. So I have, moved my daughter and others people thinking to look at buying a 2, 3, or 4 flat and having the tenants help to bring down that monthly mortgage payment. It's a great strategy to get clients into the real estate market and begin building equity. You have to remind your clients that people who own real estate, get them into the real estate market, get them into that 2 to 4 unit building, have a net worth 45 times greater than someone who's a renter. You don't want to leave them in the rental market. You don't want to let them be satisfied with going into the rental market without first at least exploring some 2 to 4 unit properties. What is a 2 to 4 unit property? Well, it's a multifamily. 2 to 4 unit property is a type of real estate that contains 2 to 4 separate living units within one building. Units are separated by walls, they have separate entrances, kitchens, bathrooms, but many share common spaces like the yards or the driveways. The properties are often referred to as duplexes, triplexes, or fourplexes. In Chicago, we call them 2, 3, or 4 flats. No matter what you call them, one person owns the property, and each unit's rent helps the owner pay the mortgage, the taxes, the insurance, and any other expenses. Multifamily 2 to 4 unit homes are affordable and surprisingly easy to buy. You don't need perfect credit or a substantial down payment. As I mentioned, you can buy these for as little as 3.5% down. I mean, that's amazing because, again, when I ask the normal customer, what do you think you need to put down as a down payment on a 2 to 4? They'll say, oh, I need 20%, I need 25% down. When we tell them that it's only 3.5% down, their eyes open up and they say, tell me more. Let's talk about it. What does the payment look like? Your future tenants help to pay your mortgage, and the lender may factor this in as income when you apply for the loan. You'll see later on that the lender uses 75% of the other units, the tenants that are paying rent, we use 75% of the rents as additional income to help the borrower, the client, qualify for the mortgage loan. In Chicago, where 2 to 4 units, they make up 26% of the rental market. That's a big number, and have a unique opportunity to collect passive income, build wealth, and benefit from tax breaks that aren't available when you buy a single family home. The down payment for a multifamily 2 to 4 unit property can vary depending upon several factors, such as the purchase price, the type of loan, and whether or not you will live there. The purchase price, lenders calculate the minimum down payment as a percentage of the purchase price. The more you pay for the place, the more you need for the down payment. So for example, if the minimum down payment is 20%, you'll need half as much to buy a $250,000 property compared to one selling for $500,000. Loan type. The down payment requirement for 2 to 4 unit property varies depending upon whether you're using a conventional loan or an FHA loan. Conventional requires a minimum of 15% down on a 2 unit and 20% down for a 3 to 4 unit property. So for example, if you buy a 3 flat for $500,000, you'll need $100,000 down. On the other hand, if you use FHA, which we're going to focus on today, because you can go all the way up to like $604,000 as the max loan on an FHA. For that, just for a 2 unit. It goes up from there to 800, goes up to nearly $1 million if you go to a 4 flat. But if you use an FHA loan, you need 3.5% of the purchase price for the down payment. So for that same $500,000 3 flat, the down payment is only $17,500. That all of a sudden opens up the eyes of many, many clients who are looking at, well, I can't afford that single family, but I might be interested in learning more about the 2 to 4 unit. So here you have that chart down below shows you that conventional is anywhere from 15 to 20%, depending upon whether it's 2, 3, or 4 units. And FHA is always 3.5%, 3.5%, 3.5% down on a 2, 3, or 4 unit property. What happens if what's the down payment if the 2 to 4 unit is going to be an investment property? An investment property is one in which they're not going to live in it. The ones that we've just been looking at are assuming that the borrower is going to live in one of the units. But if they're going to just buy it for investment purposes, a conventional loan, you need 25% down for the down payment when buying a 2 to 4 unit property. You can't use an FHA loan to buy an investment property. So FHA requires that you live there for at least a year after buying it. And maybe I'll sneak a peek for you because, again, part of the strategy that I'm going to talk about later is that I try to get first-time home buyers into a 2 to 4 unit property, live in one of them. And let's just use, for an example, a 4 unit. They live in one, they rent out 3 of them. After 1 year, they vacate the 4th unit, put a renter in the 4th unit that they were living in. Now they've got a 4 flat in which most of, if not a positive cash flow, slightly negative cash flow, they've now are in the real estate market. They have their first investment property, and now they can go forward and buy you that single family that they were trying to get initially, but they now own a 4-unit. Or what they can do is they can start over with another 2 to 4 unit property and keep that first one as an investment property. Why buy a 2 to 4 unit property? There's no other potential investment for first-time home buyers like a 2 to 4 unit property. It's an affordable investment that can generate income, build wealth, and earn tax breaks. You don't need much money up front to buy a multifamily home. If you're going to live in one of the units, you'll just need 3.5% of the purchase price. This means you can qualify for a mortgage to buy a multifamily with the same cash that you would have saved for a down payment on a single family or a condo, but you don't like the monthly mortgage payment because it's too high with high interest rates. But then when all of a sudden you look at the 2 to 4 unit property, because you're receiving rents from the tenants, the net mortgage payment becomes much more affordable. And we'll look at that in a little bit. Why buy a 2 to 4 unit property? Well, take advantage of the potentially low down payment, 3.5%. You'll need to live in your multifamily home, establishing one of the units as your principal residence. Within 60 days of purchasing your multifamily property, you must move in and continuously reside there for at least 1 year. After a year, you can move out and potentially consider buying another multifamily home or a single family home or a condo. As the owner, you'll choose the unit you'd like to live in, then rent the other units out to tenants. Collecting rent from your tenants for the second, third, and or fourth units will generate income, helping you pay back your home loan. If you buy a 3-unit, live in one, and you rent out the other 2 for $1,600 a month, you generate $3,200 in gross rental income per month. More people are renting these days. We've all seen it. They don't qualify for that 7.5% home mortgage, or they're uncomfortable with the payment. So they go into the rental market. And this higher demand means higher rental rates. The higher rents will give a buyer of a 2 to 4 unit property the opportunity to generate a steady stream of income or lower their monthly mortgage payment. Why buy a 2 to 4 unit property? Well, whether you live in your multifamily home or rent it out entirely, a steady stream of rental income combined with property appreciation and tax breaks can help you build significant wealth. Of course, one multifamily home won't make you a tycoon. Still, landlords are about 4 times as wealthy as average Americans. Again, something that the realtors can be talking about. If you're thinking of going into the rental market, let's think about going first into the 2 to 4 unit property, live in one of them, because you're going to be building significant other income, your significant wealth. Your wealth, separate from your income, is your money in the bank, along with your investments, properties, and assets, minus the liabilities like your mortgages. A multifamily home has all the promises of appreciation, as it's very likely that it's going to increase over time. As your property increases in value, you'll continue to use your rental income to pay down the mortgage loan. This is how your wealth grows over time. Somebody else is helping to pay the mortgage down. Your $500,000 3-flat appreciates at a rate of, say, 5% annually. And your wealth then grows from $500,000 to $525,000 in just 1 year. Also, because you paid $17,500 for the down payment, you'll have earned a 43% positive return based on the property's $25,000 appreciation. On top of the potential to earn income and build wealth, rental properties also come with significant tax breaks. Because renting comes with lots of associated costs, you can deduct some of the related expenses from the rental income that you report on your tax return. So, for example, you can deduct interest, insurance, depreciation, property taxes, repairs, utilities, and even lost income from vacancies can be deducted from your rental income, offsetting these costs. Because you'll collect rent from one or more units in your multifamily home, you can use this future rental income to increase your purchasing power. You use this additional income from your tenants, you'll be able to afford a higher monthly housing payment. Then this increase in what you can afford means that you can borrow more for your mortgage, allowing you to purchase a more valuable or a higher purchase price property. Future rental income refers to the money you expect to receive from a home you rent out rather than live in. We use the term in the mortgage biz to represent the estimated income a rented property will bring in. When you qualify for a home loan, we use this number as part of our calculations. We give you 75% of the rents as additional income to help you qualify for the mortgage loan. So we use the rent from multifamily home to help you qualify for the mortgage. Adjusting for maintenance costs and possible vacancies. That's why we only use 75%. The other 25% is left behind. We don't use it for income because we believe you're going to spend it on maintenance costs, possible vacancies. So the lender's only going to add 75% of the rent to be collected to your monthly income. So let's use an example. Let's say that Rose earns $7,500 per month in her W-2 job. She's considering buying a 3-unit, which she plans to live in one and collect rent from the other 2. Based on similar units in her area, each of her 2 other units will rent for $1,600 or $3,200 each month she'll collect. When we qualify Rose for her loan, we're going to use 75% of the monthly rental income, 75% of the $3,200, subtracting 25% for vacancy losses, maintenance costs, and management expenses. So 75% of $3,200 is $2,400. We're going to add that $2,400 in adjusted rental income to the $7,500 that Rose makes from her W-2 job. That totals up to $9,900. That's the income that we will now use to qualify Rose for her mortgage. Generally, your monthly housing payment should be about 31% of your monthly income. With $9,900 coming in for Rose each month, this means that she can afford a monthly housing payment of $3,070. For comparison, if Rose were to purchase a condo, the most she could afford to spend each month would be $2,325 because we would only be using $7,500, not $9,900, times that 31%, and we get $2,325. Without the rental income, the amount Rose can borrow decreases considerably. Because Rose is interested in a multifamily home, the future rental income of those 2 units, the $3,200, increases her purchasing power, allowing her to borrow more with her mortgage. So how does this strategy work? Great in theory, Glenn, but how does all this work? So let's make an assumption here. We're going to purchase a 2 to 4 unit building in a neighborhood you're willing to live in one of the units. The rent from the other tenants will be used to lower the net mortgage loan payment. The net mortgage loan payment is typically less than the mortgage payment on a single family residence. If the client buys a 2 unit, they can receive from IDA, the Illinois Housing Development Authority, up to $10,000 in down payment assistance. And for those of you that are not familiar with IDA, this is a brand new program. The $10,000 used to be a repayable $10,000. This new $10,000, it's no interest, kind of nice, and no monthly payments until the 2 unit is sold. So you can buy a $450,000 2 unit, get $10,000 to help you with that down payment, and you don't have to pay back that $10,000 until you sell it 5, 10, 15, 20 years down the road. And oh, by the way, there's no interest on that money for all the years that you've used the state's money. You can live in the 2 to 4 unit building for 1 year. Then you put a tenant into your unit. You move out, you the buyer. Now your client has an investment property with the mortgage payment being paid by the monthly rents. Now the client can buy another 2 to 4 unit building or a single family residence or a condo and begin to increase their real estate portfolio. Remind your clients that people who own real estate have a net worth 45 times greater than someone who's just a renter. So what is the purchase limitation if we use this IDA down payment assistance, this $10,000? Well, in Cook and the surrounding collar counties, DuPage, Kane, Lake, Will, it's $716,000 for a 2 unit. Well, I know a lot of 2 units that are under $716,000. What's the income limitation if we use the IDA down payment assistance? Well, in Cook, DuPage, Kane, Will, in all the Collar counties, it's 132,360. I don't know about you guys, but I guarantee you that most of you on the call know clients that make less than 132,360. So if you get a green light that your purchase price is under that 716,000 and your client makes less than $132,000 a year, and all of a sudden you got a second green light, they now qualify for $10,000 with no interest and no monthly payments. I'd be looking at this hard and fast. It's a great, great program. What if the monthly principal, interest, taxes, and insurance mortgage payment? Again, so here's an example. What if we're buying a 2-unit? And what if the client is looking to buy a $449,000 2-unit in Batavia, Illinois, putting 3.5% down? I found this yesterday in Zillow. But what would be the principal, interest, tax, insurance, the housing payment, if the client were first to look at buying a single family residence in the same price range? So if they buy the single family, the monthly mortgage payment, they're looking for that $449,000 home in Batavia, single family, putting 3.5% down using FHA. Sales price will be $449,000. The loan amount is going to be $440,000. The down payment is $15,715. At 7.5%, the principal and interest is $3,083. Taxes, insurance, then the MIP, the mortgage insurance premium. The total payment is $4,058. The client says to the realtor, maybe that's a little high for my monthly housing budget. I don't feel comfortable paying that. So I'm going to stay in the rental market because I can rent for $2,000. I don't want to pay $4,000. And so you let them go off to the rental market. And now let's look at, instead, if you had taken a look at, say, a 2-unit property, that same 2-unit that I found in Zillow in Batavia, $449,000 2-flat Batavia using 3.5% down, is the same purchase price. It's the same loan amount, same down payment. The principal and interest is that $3,083 in taxes and insurance and the private mortgage insurance. The total payment is still $4,000, but the average rent for a 2-bedroom in Batavia is a little over $2,000. So the net mortgage payment now is $2,033. So now you say to your client, yeah, you're uncomfortable at $4,000, but would you be willing to live in one of the units and rent out the other unit? And how's $2,033? Oh, you were thinking of being a renter and getting a 2-bedroom in Batavia and paying a little over $2,000, yet you could own a two-unit property and pay the same amount that you would have been paying in rent, building no equity. However, now you can buy an appreciating asset, building equity, building wealth, if you were to buy this as a 2-unit property. I think that would be an exciting conversation to have with many of your clients that did not qualify for the single family because they said $4,058 is way too expensive for me. So what would your client do? What would you do? So if the client cannot afford or is uncomfortable buying a single family and paying a monthly housing expense of $4,058, their option is to rent for $2,025 a month. Or you, the realtor, can educate them on buying a 2-unit, receiving monthly rent from the tenant that brings their net mortgage down to $2,033, which is approximately the cost of renting a 2-bedroom in Batavia. Why let them become a renter? Let them become an owner. Which do you think your client will want? Be a renter or be an owner? Do you think your client will be hugging you if you go through the numbers with them? You go through the numbers with Tony Marino and the client? Well, let's go one better. Because right now the client thinks that you're pretty doggone smart and pretty doggone great. But let's sweeten the 2-unit purchase. Let's add IDA. Remember, IDA will do 1 unit and 2 units. So we're going to do a 2-unit. The purchase price of that $449,000 is less than $716,000 because that's the max that IDA allows. So we're under that limit. Green light. We're assuming the client's income is less than $132,000. Another green light. the client can qualify for up to $10,000 in down payment and closing cost assistance. And for those of you that have been paying attention, there's no interest on that and there's no monthly payment. So they just get the money until this 2-unit somewhere down the road, 5, 10, 20 years down the road is sold. This $10,000 is zero interest loan with no monthly payments until the property is sold many years down the road. What a great deal. So instead of coming up with $15,715 in down payment, remember that's the 3.5% down, the client is only coming up with $5,715. Now you got to remember this, your client, if they're thinking, well, I got to go into the rental market, they have in the bank at least the first month's rent and a security deposit. If they're going to rent for about $2,000 a month, that means they got $2,000 for the first month's rent, $2,000 for the security deposit. They have at least $4,000. So when they're looking at the down payment is only $5,715, they're going, wow, this is getting real exciting for me now because I've got the money sitting in the bank. The interest rate on the IDA loan, you have to pay attention to this. It is not 7.5%. It is in my example here, it's 6.375, but we look today and the rate is 6.5%. But still, you're also, not only are you putting your client into a mortgage loan, instead of it being at 7.5, you're giving them a great, great rate. Tony is trying to get as many people into these IDA loans because they're at least 1% less in interest. So let's look at what the mortgage loan payment would be and the net mortgage payment would be with this lower interest rate. So now, if we look at the monthly mortgage payment, if the client's looking to buy a 449 2-flat in Batavia, putting 3.5% down, FHA, what would that now be using IDA? The purchase price is still the same. The loan amount is still the same. The down payment would be $15,715, but it's going to be less $10,000 because they're getting that beautiful IDA. They qualified for the IDA loan. The principal and interest not at 7.5, but at 6.375 is $2,750. Taxes, insurance, PMI. Now the total payment is $3,726, minus the average rent for a two-bedroom in Batavia. Now the net mortgage payment is $1,701, which is now less than the cost of renting a 2-bedroom in Batavia. Since the monthly payment is affordable at $1,701, and the down payment has been reduced from $15,715 down to $5,715, let's look at the additional cash that a client needs to get into this 2-unit. So far, they're super excited. They think that you are the best person in the world. They want to give you hugs, and they want you to, they want to meet with Tony so that he can run the numbers with you. And so now this is what Tony would do with you. He would run the numbers to show him the cash that's needed at closing on a 2-unit on an IDA purchase. Assuming it's a $449,000 purchase, 3.5% down, they're getting $10,000 from IDA. The average closing costs are about $5,500, and with IDA, you pay a 1% origination fee. Cool. If they rent, they're going to pay $4,050. First month's rent, security deposit. If they purchase, the 3.5% down payment is $15,715. But who pays it? If IDA is paying $10,000, that means then the customer, the borrower, is going up with $5,715. So the numbers in yellow are what the customer has to come up with. So far, bucket number 1, down payment, the customer's coming up with $5,715. Bucket number 2, the closing cost, that's that $5,500 in average closing cost, plus the origination fee. They're at $9,800. But who pays it? Well, I'm going to be the ultimate optimist and say that the realtor's going to negotiate for the client to have the seller pay it. Again, IDA cannot pay it because IDA used all $10,000 in the down payment. But for every dollar that the realtor does not get the seller to pay, that's going to go into the borrower's bucket up above here in yellow. And again, how can this realtor get the seller to pay the closing costs? So let's just say that they're buying it for $449,000. They have what's called a table of expectation has been met between the buyer and the seller. You represent the buyer. Who prepares the purchase contract offer to give to the seller? You do. The buyer's representative, the realtor does. But they've already said, nope, we're not paying any closing costs. So what you do as a realtor is you might go back to the selling realtor and say, my client doesn't want to pay $449 anymore. With the big sign on the other end, they go, we just went through the negotiations. We just decided on $449. What's your problem? And you say, we want to pay more. And all of a sudden, there's a wonderful tone on the other end of the phone. They want to pay about $10,000 more. They want to not pay $449. They want to pay $459. And you don't take a breath. You say, provided the seller pays $10,000 in my customer's closing costs. And they take out their calculator and go 459 minus 10,000 is 449. So to the seller, they're at the same place they were before. But it means a lot to your client because now they're not coming up with $10,000 out of pocket. That's provided that you can't get the seller to pay any of the closing costs. And the other caveat to that is you have to make sure as a realtor that when you increase the purchase price to help pay for closing costs, that you found other comparables, that you believe you're not an appraiser, but that you do believe that there is an appraisal, that the value is there, the fair market value is there to get at least $459 for the property. The last bucket of cash is what we call prepaids or escrows. And that is, typically if in the state of Illinois, we pay taxes in arrears, and the credit that we get from the seller, if we're, say, here we are in August, say we're closing at the end of September. Who lived in the property from January 1st to September 30th? Well, it was the seller. The seller must give a credit at the closing to the buyer for 9 months of real estate taxes. That credit always, always, always is greater than the amount that the lender is asking the borrower to put up into the escrow. So this number is always a net zero or negative number, but let's just say it's zero to the customer for the escrows. For the closing costs, it depends upon the negotiations. It could all be paid by the seller or a combination of seller and the borrower. And then as far as bucket number one, down payment, they're just coming up with what IDA's not coming up with. From a very optimistic point of view, in this example, the borrower's coming up with $5,715, or he can rent and pay $4,050. And that would probably mean that he would probably look for a way to buy this 2-unit property if all he had to come up with was $5,715. So the cash needed at closing, for every dollar the realtor negotiates for the seller to pay for closing costs, it reduces the cash needed at closing. Either the seller outright agrees to pay for all or some of the closing costs to help bring down the cash needed at closing. In the event the seller initially does not want to pay any of the closing costs, the realtor can suggest that the client agrees to pay $10,000 more for the property, provided the seller agrees to pay $10,000 in closing costs. Using this strategy requires that the realtor check comparables in the area that the subject property can appraise at the increased purchase price. So let's summarize. A buyer who may not qualify for a single-family home or mortgage, or who is uncomfortable with the monthly mortgage payment because of high interest rates, may find a 2 to 4 unit purchase a great way to enter the real estate market. Get into the game. Remember, after 1 year, the buyer can vacate the unit that they're living in, rent it out, and now they have a nice investment property to maintain, allowing the buyer to purchase another 2 to 4 unit property, or at this point, go out and buy their own single family residence or condo. Remember that IDA provides up to $10,000 in a zero interest loan with no payments until the property is sold years down the road. And a 2 to 4 unit purchase can make the net mortgage payment less than the cost of renting. We saw before that if they were to buy that same property at $449, the mortgage payment would be over $4,000. If they were to buy a 2 to 4 unit for the same price, the net payment would be either $2,000 without IDA, and it'd be around $1,700 if they were to use IDA. So what are you waiting for? What is your client waiting for? Now that you reviewed how easy it is to buy a 2 to 4 unit property, what's your next step? Well, it's educate, educate, and educate your existing clients. I'm sure you guys are keeping track of those clients who wanted to buy but couldn't buy or didn't buy. What a great time to go back to them. Now you have something to talk to them about other than, hey, are you ready to buy a single family residence? Are you ready to take on a 7.5% mortgage? How about having a conversation about, would you consider looking at getting into the real estate market, buying a 2 to 4 unit property? I've got my one of my team members, Tony Marino, that can help work up these numbers, showing you that it might be as little as the amount that you're paying for rent or less than what you're paying for rent. Find a 2 to 4 unit property nearby and have Tony run the numbers so you can show them to your prospects. Do a Zoom meeting with Tony. Tony's got Zoom. Do just what we're doing today, except get your client on the Zoom call and show them the numbers on a property that you found in the neighborhood. Give them a call with Tony. Show them the PowerPoint presentation. Show them the numbers. How about you guys get wild and crazy and start doing monthly home buying seminars with Tony being your guest speaker, all via Zoom, showing people that you know that are prospects that aren't in the market right now buying because of high interest rates. Why not do a home buying seminar? Showing them how a 2 to 4 unit property might be the way to start getting into the real estate market. So your goal, your homework today, what should you do next before your client buys? Well, get them pre-approved for free with Tony. You can go to your app store. You can go to your Play Store, download FCM Express, free app. You'll be able to allow them to fill out an application online there. By the way, if you use FCM Express, Tony can brand it with your face, your contact information, such that every time you share it with a prospect, it's you, not Tony. It's you asking them, would you like to get pre-approved? Would you like to use the calculator? I love FCM Express because I use it for calculating mortgage payments all the time. If I was a realtor and I was taking someone out on a Saturday or Sunday and looking at 3, 4, 10 properties, I'd be getting out FCM Express or having my client use FCM Express as I'm driving them to the next property, having them calculate the mortgage payment, the principal, the interest, the taxes, the insurance on that property. Not only does it keep them busy, but it gives them the idea, oh, this property we're going to, oh, the monthly mortgage payment is only $2,083. That's great. What your homework is to obtain a free credit report from Tony in the event that the credit score is not where it needs to be to qualify for IDA or to qualify for an FHA loan. Tony can do what's called credit rescore. He can give them an action plan saying, pay off this collection, pay down this credit card. It'll give you 10 points here, 20 points there. It'll get you to the score that you need. Your clients need to assemble then the documentation for a full app. They get an automated underwriting approval. A pre-approval letter is issued. Now that they have a yes to their loan request, you, the realtor, can go shopping for them for a home, for a 2 to 4 unit, for a single family, or for a condo. You can review the action plan with Tony. You can start hosting those homebuyer seminars using Tony's Zoom software. The Marino team through Tony want to thank you today. You get loan pre-approval in 24 hours. Tony's committed to financing dream homes and always making himself available for any questions. You can reach Tony at this 847-804-1059 or at t.marino@gofcm.com. We highly encourage you to download FCM Express because then Tony will get it co-branded in your picture, your name. So you can use it for clients to get pre-approved, and there's a free calculator to help them calculate mortgage payments. Any questions?